It felt like property prices would never decrease again in the last 2 years. They continued to rise as if there was no tomorrow. It was one of the most significant price increases in the market's history. Imagine an asset that rose in value by 1% or 2% and then suddenly increased by almost 20%. In 2020, whoever took out a mortgage made one of the best moves of their lives. However, not only has the value of your home increased dramatically, but you have also locked in a historically low mortgage rate. One of the simplest ways to acquire money is to purchase a home with a cheap mortgage rate. You'll be paying rent anyway, so why not pay down your mortgage and build wealth over time? If the mortgage rate is low enough, even if you aren't intending to live there, writing it out can not only cover the mortgage payments, but also provide some income. However, as the Federal Reserve attempts to combat inflation, house prices have begun to tremble. You can no longer acquire a 3% mortgage. The new average is 5 or 6%. A single percentage point differential in mortgage rates is significant enough, let alone 2 or 3%. In the United States, the average down payment is only 6% of the total. If we take the same house, a $500,000 house with taxes and fees at roughly 3% would cost around $3,000. But at a 6% mortgage rate, the price would skyrocket to $3,800. The discrepancy is significant, especially if you want to rent it out and make money off of it. But that's only one side of the story. The other is that house prices are falling. Experts have been warning everyone that this is unsustainable and that house prices will eventually fall. It was beginning to resemble a bursting bubble. Depending on who you ask, the news is both good and bad. If you're a homeowner, you'll want to keep an eye on how your property's value rises. But if you're a home buyer, you can finally consider buying a home because you won't have to gamble and overspend. Now, let's see if house prices will continue to rise, if the market will collapse totally before the end of the year, and if now is the ideal opportunity to purchase a property. Each of these questions, as well as many others, will be tackled. So if you're new here on Usable Wisdom, then make sure to click the subscribe button for more content that will surely kickstart your pursuit of great riches. To begin, let us summarize what happened. When the pandemic struck, the Fed was so concerned about the economy collapsing that it slashed interest rates to 0% almost immediately, especially after the stock market fell in March. Low interest rates led to low mortgage rates, which pushed demand higher. At the same time, the pandemic hindered supply chains, resulting in a shortage of materials and a decline in house supply. More than anything, many were hesitant to sell their homes, since the future appeared uncertain, further reducing the supply. What happens in the market when demand exceeds supply? Prices are skyrocketing. It appeared to be a bubble at first, and it was to some degree, but there is always a limit to how high prices can climb. Let us now consider a different scenario. What happens when mortgage rates rise? Not only would this reduce demand, but it would also force banks to grant smaller mortgages. Let's return to the example we discussed at the start of the video. Based on your income, the bank would accept you for a $3,000 monthly payment mortgage. You could have gotten a $500,000 house at 3%. However, at 6%, you can no longer afford a $500,000 home. Because you'll need to earn enough money to make a $3,800 monthly payment at a 6% mortgage rate. This reduces demand, and as a result, prices fall. However, not everything is as it seems. How will prices continue to fall if there is a global inflation? As previously stated, a general increase in prices will raise the cost of materials used to construct new homes, resulting in an overall increase in housing costs. Inflation isn't going away anytime soon. It'll take at least a year for the Fed to bring it down to 3 or 4% at best. Regardless, the median housing price has already been reduced, which has a psychological impact. People hurry to acquire homes when house prices rise, fearing that if they don't acquire them immediately, they will have to overpay later. When prices fall, however, the exact opposite occurs. People wait until they reach their bottom line when they notice that prices are decelerating. The issue is that no one knows exactly where the bottom line is. As a result, demand falls and prices fall even further. The Federal Reserve is playing with fire here. It is attempting to keep inflation under control while avoiding a recession. It's a risky game that could easily backfire. The dilemma is, how high should the Federal Reserve hike rates to combat inflation? The Fed should hike rates to at least 2.5%, according to analysts, in an attempt to take inflation down to a significant level. Consider this: if a 0.25% increase in March generated such a sharp increase in mortgage rates, what type of spike will a 2% increase cause? Mortgage rates haven't risen this quickly since 1994. In late 1993, the rate was less than 7%. They had risen to 9.11% by December 1994. In less than a year, there was a surge of more than 2 full percentage points. Perhaps the Fed is attempting to recreate a similar scenario. Anyone who knows how the Federal Reserve operates know that until there is a tragedy, such as the 2008 financial crisis, the Fed will hike rates dramatically. It was a mistake because the increase in interest rates caused a market meltdown. The crisis may have been avoided if the Fed had been more cautious and gradually raised interest rates, allowing house prices to fall over time. As a result, rather than slowing down the economic machine, they would let inflation get out of control. Because of this, many investors expect inflation to continue for another half-decade, albeit not at 8% or 9%, but closer to 5% or 6%. There are numerous grounds to support that assertion, and we didn't even consider what would happen if China launched a full-scale invasion of Taiwan. The war's shortages will be unimaginable. Even if the Fed raised rates to 10%, inflation will be so high that it will make no effect. Let's hope it never comes to that. The big concern is whether the market will crash before the end of the year. The answer is most likely no. While property supply is returning to pre-pandemic levels and mortgage rates are rising, this is insufficient. Prior to the pandemic, there was already a scarcity of homes on the market. As a result, restoring supplies to their original level will make a little effect. Will prices continue to fall? Yes, most likely, although it is currently happening and may continue through the end of the year. Didn't a 20% spike in housing prices cause a bubble? During the pandemic, 1 out of every $5 in circulation was produced. You can't possibly expect to spend that much money and anticipate costs to stay the same. It's one of the side effects of the printing press. Following each crisis, there is a gold rush in which everything increases drastically, but it eventually settles. We had our gold rush, and whoever made a fortune was fortunate. Those that didn't, well, there's always next time. But in the meantime, subscribe to our channel and hit the notification bell so you'll be ready when the next big opportunity presents itself. Thanks for watching. I hope you learned something meaningful from this video. Until next time.